Hey guys, welcome to BroTalk. In this episode, we will be speaking about the Federal Reserve. When did it start? Why did it start? And how its role in government has evolved throughout the years. We want to be able to simplify this information so we can help you or the average American into getting to know more about these interest rates, the loans, the mortgages, the savings, and how to help you guys into building wealth more and more. So please, guys, tune in. Like the video, comment, and subscribe.
All right. So, I think this is a very important topic, not only for you and I and all the investigation we did, but I think for a lot of people out there to listen, because we always hear Federal Reserve and they're the ones who are talking about, they always come up in the news, I think what's his name? Jeremy Powell is the chair right now of the Federal Reserve.
Yeah.
But people don't really understand, what does the Federal Reserve do, or like their history and why they're so important for this country, right? I know in another episode we spoke about kind of the importance of the Federal Reserve in the economy, right? Because they're the ones who are controlling the economy. They're considered like the economic thermostat, right? When if the economy gets too much, if it gets too hot, they got to bring it down.
Right.
If there's a recession or the temperature of the economy is too low, the Federal Reserve has to bring it up, right? And so forth. It's a cycle.
Right.
But I think it's important that we talk about their history, and I think you're going to talk about the history and why they're so important. And so give us some facts so we can start to get this ball rolling, this conversation going.
Well, yeah. I mean, a lot of people don't really understand what the Federal Reserve is and what its purpose. But to simplify it, what I was able to investigate and to simplify it, it says the Federal Reserve is made to bring stability to the U.S. financial system.
Yes.
It's basically the central bank of the United States. It determines the monetary policy. It controls the money supply. It's basically the financial institution that has the power to control the production and distribution of money and credit information.
Okay.
Right? And how did this start? Well, it started in 1913. The main goal for the Federal Reserve making was to prevent banking crisis, right? And allowing to have emergency funds just in case, right? And we've seen how these banks, because basically the Federal Reserve, not that it's controlled by these banks, but it evolves around these banks. I believe there's 12 banks in the United States at the current moment that supply this monetary banking system, basically, right? And whenever the country is in some type of crisis, right? Let's say we're going through a recession, or there's a war, or inflation is high, or inflation is low, is when the Federal Reserve steps in, right? We've been able to see how the Federal Reserve has been able to step in throughout time. For example, during the Great Depression, and that was around the 1930s. We've also been able to see it throughout post-World War II. We've been able to see it throughout the recession of 2008. And we've been even able to see it throughout in recent history and during the pandemic. During the pandemic, they responded quickly because they had to lower interest rates. And they had to basically inject large amounts of money into businesses into businesses and consumers to keep them afloat.
Of course, yeah.
Right? So that's what basically the Federal Reserve is. It ensures the stability of the country. And how does it do it? By like managing interest rates, controlling the inflation, and making sure that unemployment is basically low.
Is low. It's interesting because you mentioned at the beginning that the Federal Reserve came to be, right, because to avoid banking crises, right? Because this happened recently. I don't know if you remember. I think it was called like Silicon something Bank.
Yes, and it went out of
business.
Yeah.
And I think, from my understanding, it was a business bank. So a lot of these
smaller bank, yeah.
No, it was a huge bank.
It was a huge bank.
It was a huge bank, but it was these startup companies in California. This is where they would put their money. But what happened is that some news came out and people heard it and they freaked out, right? So what did everyone do? Everyone went, they ran towards the bank, and everyone at the same time went to take out their money. And when people do that, that is called a bank run. That's called a bank run.
And that's exactly what was happening during the late 1800s and the early 1900s.
Correct.
The reason they wanted to create this Federal Reserve is so people they would avoid people from doing bank runs, right? They see that the economy is not doing well. People would just run and take out their money. And all that led to instability into the economic growth of the country.
Mm-hmm.
Therefore, that's one of the reasons they also created this Federal Reserve. But you're totally right. When that Silicon Valley situation happened, that's what naturally people do.
Yeah, people freak out and you want to take out your money because you worked hard, right? So as you said in the beginning, before the Federal Reserve, there were so many banks. When this country started to form, there were so many banks that were trying to. There was federal banks, there were smaller banks, there were state banks, and all these banks. Right now, it's crazy. But sometimes what people would do, like the competitors, they would make up a rumor. They would say a lie and make up a rumor about this bank. People would hear and people would freak out and people would go and take the money. Everyone would go take out their money. And what would happen? The bank would fail, right? But because technically, if right now, like let's say, let's say, bank ABC, right? Right. If people freaked out and every one of their clients wanted to take out their money, that bank would go to business.
I don't even think the bank would let you.
Oh, yeah.
At a certain point?
At a certain point, they wouldn't let you.
Just because they would see they're losing a lot of money.
But also, most of the time, banks don't have all of their money in that one location. It's flying all over the place.
That's true. Okay.
Yeah, but I'm gonna please continue.
Like different stocks and everything. Yeah, I get you. But yeah, one of the questions that we did want to answer, if it's still playing the same original purpose, or has it become something different over time?
Yeah, like has the federal? So wait, from my understanding, from what you're saying so far, I just want to reiterate. You're saying the whole job of the Federal Reserve has to do with the economy, to make sure that the economy is stable, low unemployment, and there's money flowing in the country, right? And it also has to do with interest rates for all types of loans, right?
Yes.
The Federal Reserve is the one that's like turning on and off. They're controlling all this.
Yeah. So we've previously talked about in previous episodes talking about how inflation is, how sometimes like a wave, right? It goes up, it goes down, and that's how it continues, right? So whenever it goes up, inflation goes up, interest rates.
I'm sorry, say it again.
When inflation goes up, interest rates tend to go high, right? So then there's no borrowing money. People aren't.
Well, remember.
No. It goes low, therefore it creates stability. If I'm not wrong.
So yeah, what the Federal Reserve do when interest rates are going when interest rates are too high, right? The Federal Reserve makes sure that interest rates go high to kind of calm down inflation, right? But then once inflation is gone, but there's a recession or the economy is not booming, they make money cheaper. So people can borrow, and the economy makes it easier to borrow, and the economy goes up. But then once it gets too much and there's too much inflation, you have to raise interest rates.
Exactly. So when inflation is high, and the economy is like already booming, they have to control those interest rates and make it high as well. So then it's more. It's harder. It's harder to like buy stuff or borrow money. And it helps. Well, it doesn't help, but it depends on the person. But it promotes people to save their money as well.
Correct.
While when inflation is low, it's much easier to borrow, right?
And the people are not saving as much. They're spending more. Yeah.
That point being said, that was like the initial purpose. Obviously, also avoiding bank runs and all that from the people. The initial purpose of the Federal Reserve, but it has expanded over time. For example, post World War II, it gained the responsibility for promoting employment and economic growth alongside, right? In 2008, it took more of an active role stabilizing the financial system, using emergency lending to buy government bonds to put that into the economy. And one of the people that played a big role in that, from what I was able to investigate, was JP Morgan Chase, the bank, ended up playing a big role because then ended up buying a smaller bank that I believe went into bankruptcy.
Okay.
And then during the Obama administration is when they were able to sign the bill. I believe it was around, I don't want to get the wrong number, but it was a very, very like high number to be able to help us get out of that recession.
Okay, gotcha. Okay.
So, and the same thing happened recently during the pandemic, where they had to inject money. So I've seen that as time has passed, different circumstances have been proposed, and therefore they've had to play like a little bit of a different role, not only trying to control inflation rates and having people to avoid bank runs. They've had to promote economic growth. They've had to learn how to keep the unemployment much, much lower. And whether they're injecting money or not, they've used like different strategies on being able to keep our country moving, basically.
Interesting. Okay. So then if you had to summarize that in 1 or 2 sentences for the average person, what would you say? If you had to break down
of what the Federal Reserve is?
No, how they started and how they've like revolutionized to what they do now. Like, are they doing the same thing or have they changed?
Well, they are doing the same thing. They're probably playing a bigger role when it comes to economic growth.
Okay.
Maybe I would summarize it in a way where like the Federal Reserve was initially made to help stabilize the country when it comes to money. Controlling interest rates, avoiding bank runs. But as time has passed, we've faced different trials and tribulations and struggles that we've had to overcome. Therefore, knowing the amount of power that the Federal Reserve has in monetary control, it's had to play
a bigger
role in certain situations depending on what it's been presented. Basically,
that makes a lot of sense.
It's a very general way to present it. We could go into specifications on how they've played a different role.
Yeah,
but as an overall, as World War II passed, as after the Great Depression, after the recession in 2008, after the pandemic, I believe because of these circumstances that the country needed help, they've had to play a bigger role.
Interesting. Okay. That makes a lot of sense. And again, we can get into a lot more specifics, but I think for now, this is good.
Yeah.
Right? Now, I think one of the bigger questions that I think a lot of people who are going to be listening to this conversation is, okay, so I know what the Federal Reserve is, and I know how they've evolutionized, right? How they've gotten bigger, how their role has gotten big. Okay, great. But does that information impact me as an American? Like, or how's it going to affect me on an everyday basis, right? And I think I want to start with this one first, and then I want you to chime in and you tell me what you think. So, first of all, what I would say is this. What I would say is, and I think this is a very crucial thing to know about the Federal Reserve. So the Federal Reserve controls something called the federal funds rate.
Okay.
Right. Now, I'm going to read it first, and I'm going to explain it and give you an example. The federal funds rate is the interest that the banks use to lend money to each other overnight.
Okay.
So when the Federal Reserve raises or lowers the rate, this federal funds rate, right? That's what the Federal Reserve, right? If they make it higher or lower, it impacts all other interest rates in the country, including loans. Millions of Americans have loans, mortgages for their homes, and savings account. Okay. So, and I think that's very important. So, and I want to give an example from the 80s, a time when the Federal Reserve raised the federal funds rate. So basically, the Federal Reserve, right, obviously, as you said, they're injecting money into the economy, right? One way they do that is they give the money to banks, right? Now, if I'm the Federal Reserve, and let's say you're Citibank, let's say, I don't know, right? And I'm like, okay, Citibank, I'm going to give you, and again, I'm going to use stupid numbers, stupid examples. I'm going to give you $1 million, let's say, but I'm going to charge you as the rate 5%. Okay. So if you want this money, I'm going to charge you 5%. Citibank's like, okay, I'll take the money, no problem. Now, In order for them to get that money, the Federal Reserve just charged them whatever, 5% or whatever other percent, right? Okay. So now, if they took that money, Citibank takes that money, okay, now I have customers, I have clients in my Citibank. I'm going to give it to my clients for their mortgages, for the loans, right? Right? If the Citibank, if I give someone a loan, a car loan, right? Here's a car loan for you to buy the car, and I'm going to charge you 5%. Is that good for Citibank? Yes or no? The Federal Reserve gave me $1 million at 5%. I'm going to give everyone now a loan for 5%. That's not good because they're not making any money, right?
Yeah, you're hitting like
you're like equal.
Unless it's surpassing $1 million, then you'll be making more money. But
Uh-huh.
I don't know if you get what I'm saying.
No, I don't.
Like, for example, you said about the $1 million, right?
Uh-huh.
So I get $1 million. Now I'm spreading it, right? I'm giving 20 over here, 30 over here, depending on what your mortgage or loan is. And I'm charging 5% here, 5% here, 5% here. I guess it depends the amount of people I lend the $1 million to. I can make just the money back. But of course, strategically or thinking, right? I'm not going to charge 5%. I would charge higher.
Correct.
Because as they say, the bank never loses. The bank would help you. Here's the money. I'm going to get my money back, so I'm able to pay back the $1 million that I made, but make profit as well.
Make profit as well.
You know why? Because at the end of the day, I need to make more because they're also charging me a 5% interest rate.
Correct.
Right? So they're winning, but I also don't want to lose. Right? So what I'm going to do, I'm going to make the people lose. In a sense.
Or pay more.
Or pay more. So then I'm able to cover this interest rate and probably have profit after that.
Of course. So they have to charge higher, right?
Yes.
So
it wouldn't make sense to just charge.
It wouldn't make sense. Yeah. But you see how interest rates can change based on that? When the Federal Reserve gives money to the banks, they're going to give it the bank at a certain rate from the federal funds rate. That's the interest rate that banks use to lend each other money, right? So the banks now that all these banks, Citibank and whatever, KeyBank, TD Bank, whatever, all these banks have all this money now that they got from the Federal Reserve. So if they want to give money out to their customers or lend each other money, because sometimes a bank might need money, right? So it's like they'll call another bank, hey, I need some money. Can you wire some money for me and whatever, and they'll charge the interest, right? But you're right, it has to be at a higher rate so they can make a profit, right? Yeah. Now, so I'm going to give you an example, something from the 80s. It was called the Volcker shock, right? Now, in the 70s, inflation was very high for many reasons, right? Now, Paul Volcker, at the time, he was the president of the Federal Reserve, and he, in the 70s, he decided inflation is really, and we just spoke about it. If inflation is really high, I got to bring inflation down. How do I bring inflation down? I need to make interest rates high so it can come down, right? So he decided at the time, I'm going to make interest levels really high to control inflation. So in 1981, the federal funds rate reached 20%. The federal funds rate, the money that the Federal Reserve gives out to the banks, reached 20%.
Wow.
That's high. That's very high. That doesn't even happen today.
Yeah, no.
So because it was so high, what happens now? Now the banks, they got the money. Okay, we have to lend it to our clients, but in order for us to make a profit, we have to our interest rates have to be higher than that.
Yeah.
But no one's. Would you take out a loan that's 20% interest rate? Never. So, for example, the mortgage rates. So when the federal funds hit 20%, mortgage rates for regular Americans soared to 18%. So I wrote a little example here. Imagine if you took out $100,000 mortgage at 18% interest, your monthly payment would be around $1,500. And from that $1,500, $1,229 is just interest alone.
Wow.
Just interest. Just interest.
That's insane.
That's crazy, right?
That's insane.
Now, at the time in the 70s, in the 80s, when Paul Volcker decided, I'm going to do this, raise it to 20%. And again, he was thinking long term. This is going to help bring down inflation. It might not help. It might not be good right now, but it'll be good later on. And he was actually right. Right? So it's like, we'll suffer in the short term, but in the long term, we're going to be good,
Yeah.
right? So banks like Bank of America and Citibank were hit hard because it was so expensive to get this money, and their clients or customers, most of them were not going to take out these loans. So they were kind of in like a bad spot. So what do you do? So for example, Citibank, for instance, during this time, they faced massive defaults because people, like regular average Americans and businesses, couldn't afford high interest loans anymore, and they couldn't make the payments. So people can't make payments. No one's going to go borrow money because I can't make the payment. So if that happens, what happens then? Businesses can't really grow because they can't really borrow money because it's too expensive.
Yeah.
So maybe they got to find money other ways, but they're not going to go through the banks. Regular Americans, they're not going to buy homes, they're not going to buy cars. So the economy is going to start to go down. But that's what he saw. He was like, inflation is way too high now. We got to bring it down. So this is what we have to do, right? And I just wanted to mention one more example, and then I want to hear your thoughts. So, right, like if we had to put that today, it's like if Bank of America, let's say, borrowed $1 billion from the Federal Reserve at 20% interest, in 1 year they would have to pay $200 million in interest alone. Interest alone. So that means they have this money. They have to figure out a way to make this money become profitable. But how do you make it profitable when most people don't want to borrow money? That's where the challenge comes. So I just thought that was a fascinating, interesting thing. Anything you want to mention about that?
The question was, well, you gave examples, right? Of
Correct.
How the
Federal
Reserve getting the money, giving it to the banks giving it to the people. My worry would be, right, for our audience, understanding that explanation. How does that impact maybe the average American when it comes to them taking out loans, to them taking out mortgages, to them saving money? I would assume, right, during that time, you would just have to play along with what the economy is happening to show, right?
Correct.
If we're at a high interest rates, then there's no reason for me to be taking out any mortgages, any loans. When it's low, it's when I could end up borrowing more money. It's when I could probably make investments. It's because it's safer to do so, right? Because at the end of the day, this is all going to impact the average American more than what it would impact the Federal Reserve, than what it would impact the banks. Because at the end of the day, we're losing, but we just have to be smarter on our decision making when it comes to, I guess, saving our money, because we're trying to build wealth.
Yeah.
Right.
So I would say, to answer, because that's a good question, and I was trying to get there, but I'm glad you asked it. So I summarize it. So the way I would like to summarize it for everyone watching, and I think you would agree with me, is this. This is the summary. I do think it's important for people to anytime you hear something about the Federal Reserve, I think even for normal people,
to pay attention.
You should pay attention.
Yeah.
Now, of course, most people, we're not going to control the Federal Reserve. We have no input on what the government is doing or not doing.
No impact, yeah.
Or no, sorry, thank you. No impact on what the government, the Federal Reserve, right? We have to go along with what's happening. Okay. So I think it's important to first know when inflation is high or not. Why? Because when the Federal Reserve raise the rates, when they raise the federal fund rate, let's say, or whatever, right? They raise this, then you got to know that borrowing is going to become more expensive. Loans,
you can
mortgages.
Anticipate.
Yes.
Sorry to interrupt you. I'm just
no, 100%. Tell me.
Trying to read through your words. Like, you can anticipate, if you're updated with this information and you're seeing how the economy is going, you can anticipate what's coming.
You can anticipate, and you can already kind of predict because you know the information. So if you know that it's going up higher, then you know, okay, right now is not a good time to go borrow money from the banks. And I'm going to actually give it an alternative, what you should do instead, and something that you and I are doing, right? But so when there's a higher federal funds rate or interest rates are up, saving is the more important thing. You got to start saving your money. However form you want to do it, save your money. Don't borrow from these expensive, from these loans that are super expensive. But when the Federal Reserve lowers the rates, that is when you know, okay, borrowing is going to be cheaper from different institutions, right? I can borrow money and leverage money, right? I can borrow money and I can get investments that are cheaper, right? And I can figure out a way where I can still be profitable. Now, what I would say is instead of going to a bank, right, and go borrow money from them, create your own bank. Something that you're doing, something that I'm doing right now. What I would say is go create your own bank. What do I mean? And I've said this in other episodes, but I'm going to explain again. Is you want to open up. And again, if you guys are interested if they're interested in a book, I'll mention a book afterwards.
Right.
The Blueprint to Financial Freedom, phenomenal book by Jerry Fetto. Right, but going back, so you want to make your own bank. Open up a simple whole life insurance policy. I have a couple. I don't also has a couple from Guardian.
Yeah.
Right, but there's the different companies. Open up a simple whole life insurance policy and save as much money as you can and put it there for two reasons. Number one, you'll be making interest on your own money anywhere from 3 to 6%. It changes every year. But not only that, most importantly, depending on who structures your whole life insurance policy, you can borrow anywhere from 75 to 90% of the money you put in there immediately. You can borrow that money out, but it's still growing 3 to 6% every year. And you can use that money, whatever, to pay off high interest debt, or more importantly, you can start buying assets, investments. And you can do this even if the Federal Reserve raises the rates, or if the federal fund rates is lower. It doesn't matter what's happening. You always want to be putting money here, right? Always want to be putting money there. It's always going to keep growing. It's not going to go down. And you're creating your own bank. You're starting to create your own economy,
Okay.
right? Maybe you're becoming your own federal.
You're becoming
federal raise. I mean, not really.
You're becoming your own Federal Reserve.
Your own Federal Reserve.
I think it's a very simple strategy, but it's a very effective strategy.
Correct.
Right? Because this is how individuals or the average American can position themselves to benefit from whatever the Federal Reserve policies are.
Mm-hmm.
Understanding that these policies aren't, at least in my opinion, geared for the benefit of the average American.
Mm-hmm.
I would say they're more geared for the large institutions, for the banks to benefit from, but like they aren't geared for the American to benefit out of it. Then what's a way that I could benefit regardless of what the Federal Reserve policies are? And that would be a very simple but effective way. Create your own Federal Reserve, in a sense. Create your own bank, where I'm putting money into it and I can borrow out, and there isn't no change of interest rates, right? And obviously, like you said, if you talk to the right life insurance agent, you could benefit a lot from taking from anywhere from 75 to 90% out of your life insurance.
100%. And I would say that, right, no matter what's happening with the Federal Reserve, I'm going to give a couple tips. Number one, you want to focus on cash flow, not just interest rates, right?
Okay.
You want to focus on increasing cash flow rather than being concerned with the interest rates by the Federal Reserve, right? So that really just means, okay, this is how much I make. Either you decide or you figure out, how can I make more money at my career, at my job, as in a side gig or an investment, or maybe I have to lower down my expenses, and then I can save more money and I'll have more money on hand so I can put into my own bank, into my own economy. So focus on cash flow, not on interest rates. Yes, have in mind interest rates so you know what's happening, but don't put your full focus. Second of all, I would say you want to use low rate environments to invest in assets. And I wrote here, you want to focus, right, on acquiring income producing assets like real estate, maybe buying a small business or a big business, right? You want to focus on getting income producing assets because you'll benefit from both low borrowing costs and the assets appreciation over time, right? Again, there's different types of investments, but it's always better to focus on investments that are safer. Now, is real estate safe? Somewhat it is. Actually, it really depends who you ask, actually. Some people say real estate is very safe. No matter what happens, real estate always appreciates over time, and there's many ways to make your money back, right?
Yeah.
But other people would say otherwise. But whatever. Let's put that to a side, right? So again, use low rate environments to invest in assets. So when the Federal Reserve lowers the rate, again, that should be your sole focus. But when that happens, that is your chance to borrow money out of your whole life insurance policy from your bank, take out the money and buy income producing assets of real estate, residential, commercial, right? We're more into the residential.
Yeah.
But right, the tenant pays every month rent. That becomes an income producing asset. A business produces income and so forth, right? The third one I would say is when the Federal Reserve raises the rates, or the federal fund rate is high, during high rate periods, focus on paying off bad debt, right? I'm going to quote something. So this is not my own words. When rates are high, right, it's better to pay off any bad debt, like credit card debt, as quickly as possible, since high interest debt can snowball. So for example, you can refinance an existing loan while rates are low, or fix to avoid paying more in the future. So now you have this idea, okay, we're saying when the Federal Reserve lowers interest rates, or the federal fund rate is lower, that is when you want to buy more assets. You want to buy more assets, take the money from your own bank and buy them, right?
Yeah.
But when the Federal Reserve has high interest rates, or the federal fund rate is high, this is a good time to pay off debt. Of course, if you don't have debt, even better, then figure out a way to still borrow money out of your own policy to buy assets that are in the right price, right? But you want to pay off bad debt, and credit card debt is one of the worst debt out there. Student loans and credit card debts are one of the worst loans out there, right? So beware of those. And the last one I would say, and then I want to hear what you have to say, is build wealth through long-term strategies. I think this is definitely something I'm learning. Building wealth is not a one-year thing. I mean, unless
Here's a jackpot.
Unless you're the jackpot, or you hit a viral YouTube video and you got a bunch of sponsors. But for most people, building wealth is a long-term thing. And a lot of times we as people, we think too short-minded. We're thinking too close right now and not in the future, right? We need to think beyond the short term and focus on wealth building tools, right? One of the mindsets is, hey, let me do what the banks are doing. Sorry. What are the banks investing in? What are they doing? Let me do the exact same thing. Now, obviously, you might not be at the same scale, but you could be in your own scale and slowly build up and focus on that. And don't freak out if you hear the Federal Reserve raised 2 more percent or 2 more points on the rates. Don't freak out. It is going to affect. It definitely affects us.
All of us, yeah.
It's called the trickle-down effect, because you said it really affects the banks and large institutions, but eventually it will affect us at some point. But focus on these things instead. Do what the banks are doing. Pay attention, but don't pay too much attention. So what do you think about all that?
No, I think these are great strategies. My answer is I think even more simplistic. It just comes down to the mindset. Everything comes down to your decision making, and how you approach whatever's happening currently in the economy, right? And if you're capable of micromanaging your money to an extent where you're able to save, you're able to put them into assets. Whenever the inflation is low, you could borrow and put it, like you said, into things that are assets that provide cash flow, is where you could lead up to success, regardless of what's happening with the Federal Reserve, of how the banks are managing, depending on the money they get from them. It's an effective way, right? You also mentioned about the life insurance, and understanding that for the majority of us, and this is us included, at least for now, building wealth is slow, or it's a long-term process, right? Hopefully you could try to expedite it, right? Instead of 10 years, we can make it 5. Instead of 20 years, you can make it 10, right? Depending on the decisions you make, the money you're able to save, the investments you make. But because everything just comes down to mindset for me, and that's the way I see it.
Mm-hmm.
But it's interesting how we've been able to talk about the Federal Reserve, right? How it started in 1913,
Mm-hmm.
how the reason it was created to stabilize the economy, to avoid people from doing bank runs, how its role has evolved throughout the years because of wars or because of pandemics, because of recessions that we've been through, how the Federal Reserve has played a bigger role as those problems have passed, right?
Mm-hmm.
We've also been able to summarize some strategies for the average American on what they could do to build wealth, to understand how, now that we know what the Federal Reserve does and how it provides money to the banks and how the banks act upon that
Mm-hmm.
towards the average American, how could we as the average American go about that,
Mm-hmm.
right? So now that we've been able to summarize that, I don't know if it would be a great transition to really see if we actually need the Federal Reserve. If we actually need the Federal Reserve, right? Because, I mean, I'm sure people have arguments
About this,
right? Do we need it? Do we not need it?
Mm-hmm.
If you look into politics, and I believe this was a conversation we were having earlier, majority of libertarians can make an argument that they don't need it, right?
Correct.
That we believe in the smaller government, right? And things like that. But there are also arguments contrary.
Mm.
So what do you think? Do we need it or do we not?
According to who? Libertarians, Republicans, Democrats?
According to you.
Me? So from all the arguments I've seen,
Mm-hmm.
and up to today,
Mm-hmm.
and I got some interesting arguments here.
I have a lot to say.
From all the research that I've done so far and what I've seen today, yes, I think America or our country, we still need the Federal Reserve. The Federal Reserve is very, very important. Yes, so I do think we need them. Yes,
I disagree. I'm joking.
Really?
No, I agree. I think we still need it. And it's interesting, right? Because I don't believe a lot of people know this, right?
Mm-hmm.
Do we need the Federal Reserve? Yes or no? I believe we do need it. Why do we need it? But before we even answer the question of why we need it, we have to break down on what backs up our currency.
Okay.
Right? The currency that the Federal Reserve provides to the banks, right?
Mm-hmm.
So the currency that we're not the only country that has that type of currency. Many big, powerful countries have it as well. It's the fiat currency.
The fiat currency, yeah.
The fiat currency it's not real. It isn't backed up by any commodity.
Mm-hmm.
Literally, it's backed up entirely by faith and trust in the government.
Oh, I think you would say trust in God.
No. I mean, but yeah. And the opposite of that would be commodity money. Really, basically something backed up and derived by the materials it's made of, right? For example, gold, for example, silver. And that's something that we used to do in the past. I was reading about this, how President Richard Nixon decided to abandon the gold standard that we had in 1971.
Yes.
Which meant that the US dollar was no longer convertible into gold, meaning the amount of dollars printed wasn't tied to the amount of gold stored by the government. That being said, before 1971, our currency was backed up by gold.
Mm-hmm.
After 1971, it isn't. And now it's backed up by faith and trust in the government, right? How the market runs, basically. That being said, why do we need it? People would say, people could ask, why is my answer yes? Well, because throughout history, after 1971 until we are now, 2024, with fiat currency, we've been able to stimulate much more our economy, right? We've been able to progress more because the gold has a disadvantage that the fiat currency doesn't.
What is it?
Which is gold is limited.
That's
right?
true, yeah.
Right? Well, how do we get gold? Well, we have to mine. And
Yes.
that would be depending on the natural resources that Earth provides to us,
Mm.
right? And that's all limited to a certain extent.
Mm-hmm.
If we can't find here, we have to find somewhere else. And if we don't find, then we only have this. And how can we stimulate our economy, overstimulate our economy to grow much faster? Well, we wouldn't be able to do that with only a certain limited amounts of something, of material. That's how we back up our currency on. We would have to back it up on something that isn't real, on something that we could continuously put more money and more money into it, right? And that's what the fiat currency is. And at this point, 2024, we've overstimulated our economy so much that I don't think we would ever be able to fall back into the gold standard.
Never again.
Never again. I don't think so. Into currency, which is why, like, we've done so much overstimulation on everything. We need the Federal Reserve, not only for that, but I believe, I'm sure it has its cons, but its pros of controlling inflation and keeping America uphold
and stable,
and stable has done more good than bad, is what I would argue.
So there is some bad though, but you're saying it's done more good than bad. So
there is a disadvantage. The disadvantage of a fiat currency or of having the Federal Reserve use fiat currency, right? Or would be is the risk of inflation, like we spoke about, of money being overprinted, because it causes a loss in value due to its lack of intrinsic worth and dependence on the government's stability, right? But at the same time, fiat money is also cost effective. I was actually studying. I got so into it because I was like, why can't we go back to gold, right? Because
I was about to ask you that, but yeah, tell me.
If we actually went back to gold as our backed up currency, right? The gold price today would jump to $27,000 an ounce.
Wow! And how much is it? I think right now it's like what, 2,000 something?
I don't know. I know it's been going up from the rumors that I've heard.
Well, we also buy gold.
We buy gold.
We buy gold a little bit.
But like from the PVD podcast, he talked a little bit about it, I believe, the other day. And he talked about how gold prices were going up, right? So if we ever went back, and this is me answering your question, I believe the question, why can't we go back to it? Because if we would go back to it, it would actually do more harm than good, because there would be a lot of restrictions on the ability to finance stuff. And one of those things would be like the national defense, right? So much money that we've put into it, we don't have enough gold to back it up, to
convert it back from fiat currency to gold standard. And then it'll be too expensive because 1 ounce of gold is $27,000.
Yeah.
Right?
Yeah. And it would, the overstimulation that we've done into our economy and with the amount of money that we've put in, gold wouldn't be able to uphold that, I believe. I believe we have 8-point-something metric tons of gold here in the United States. We're actually the country that has the most gold. We are the most? I believe so, yes. Okay. I don't think I'm wrong on that, but
do you want to check?
Yeah, you can check.
I'll check for you just in case, so no one accuses us.
Right.
Wait, what's the question? Who has the most gold?
Who has the most gold in the world?
The most gold in the world. I'll tell you right now.
If I'm wrong, I'm going to be so upset.
Yep, the United States has the largest gold reserves in the world with 8,133 tons of gold value at $628 billion. You're right.
Right. Okay. You said the number. What's the number again?
$628 billion.
$628 billion. Well, our national debt is over $31 trillion.
Nice. What? So we have more debt than gold.
We have more debt than gold, right? And that would cause another issue, but we're not going to get into that. Yeah. One other thing that I also wrote is that gold tends to hold its value, while fiat can either lose or gain. Correct. Depending on inflation. Correct. Right? That's why gold it's much more of a stable thing. Right? But the flexibility that the fiat currency provides and allows the government to stimulate the economic growth,
Mm.
while gold would just provide stability and limited inflation.
Mm.
So would we have much more of a limited, I guess, inflation in our government and have stability? Let's say we had enough gold.
Okay.
Yes, but we wouldn't be able to progress things as fast as we would want to. As with the fiat currency, we're able to like inject all this fake money into the government, and it allows us to move or progress much faster, right?
Interesting.
So that's why I believe the Federal Reserve is necessary. I know I went into like a whole shebango, but if you don't want to go back into the gold currency, you could go back into the barter.
Oh God, no, that's even worse.
The barter economy.
That's not a good idea.
Which is back in the day. If people don't know this, basically trading good for services, right? So, as an example, talk about the mechanic. We talk about a farmer, right? And let's say the mechanic has a scale to fix tractors, and the farmer has food. Now the mechanic has to go find a farmer that needs his tractor fixed, and he goes finds it. And now, okay, I'll fix your tractor, but you need to give me some food. Okay. But what's the value
of the food?
What's the value of me fixing your tractor on how much food you could give me? How much food can I get? Right? That's why it's hard to
like kind of measure
the value of what the mechanic is worth and what the food is worth, right? So obviously we would never go back into that type of economy because it just wouldn't work out. Those are like ancient times on how they used to do it. But ever since then, we've relied on gold, silver, and then now we rely on fake money.
The fiat currency.
On the fiat currency, right.
Interesting. But at the end, you're saying that, yes, we still need the Federal Reserve because they help more than, they do more good than bad.
I believe they do more good than bad, yes.
Okay, that's interesting. I definitely agree with you. We definitely need the Federal Reserve for different reasons.
Okay.
So, for example, I got a couple of interesting quotes here that I would like to read, and then I want to talk about a little bit with you. Okay. So, for example, I'm first going to speak from the Democratic side, right? So, for example, and the source I'm using now. This is for the Federal Reserve. Like, this is a Democrat saying the Federal Reserve is a good thing because the Federal Reserve stabilizes the economy. Okay. Right? Because the Federal Reserve has a role in managing monetary policy, stabilizing the economy in times of crisis. And the example was the 2008 financial crisis, which you mentioned, which was what happened was that the Fed's actions during this crisis was that they lowered interest rates, right? And they implemented quantitative easing, which is a technique that the Federal Reserve uses, and it helped prevent a full-blown depression by injecting tons of money, liquidity into the economy, and it saved many financial institutions, right? So this is one big argument saying Federal Reserve is a good thing, because it's true. If the Federal Reserve did not do this, the 2008 financial crisis, which was really bad, and my father really got affected because he was in the real estate business, and real estate was one of the first things to get affected in the 2000 financial crisis. If they would not have reduced interest rates, and remember, when interest rates go down, borrowing is cheap. During COVID, they did the same thing. Yeah. They made everything super cheap.
That's why a bunch of people bought a whole bunch of stuff, cars, and
people were buying everything because money was so easy to get. Yeah. But it had to be done because everyone was inside.
Inside, you couldn't go out. Yeah.
So no one was really spending.
And they needed to uphold these businesses to keep afloat.
It's 100%. So this is showing that, yes, this is an important thing, right? Now, and the source was an economist, Paul Krugman, right, who is a progressive that argues that the Fed is important, right? Now, they're important because they help cushion the impact of a crisis or of a recession. So the argument is really just talking about really bad times, crises and recessions, which countries go through them. That's a normal thing that happens. And we have the backup as the Federal Reserve. Now, I'm going to mention an argument that goes against the Federal Reserve from a democratic perspective.
Okay.
And then I'll go into the Republican one.
Okay. No problem.
So the argument is that the Federal Reserve is not a good thing because it exacerbates wealth inequality. A lot of people talk about wealth inequality. America, we have so much, we have the 1%, let's say, in America, but then we have so much millions of Americans who are like at the lowest level.
Yeah.
And it's like this. And that's unfair. There's an inequality of wealth. The most poor and you have the richest up here.
Yeah.
It should be more leveled, right? This is what they say.
Okay.
So, for example, they'll say that the Fed monetary policies, like, for example, lowering interest rates, that's what we're talking about, and other ones, yes, help stimulate the economy, but it tends to benefit wealthier individuals and corporations way more than the average American. So, for example, when the Federal Reserve lowers interest rates, which we spoke about, the stock market many times goes up. Why? Well, one reason is, as we mentioned, because remember, when you have access to cheaper money, people spend more, people invest more. So when people have more money, maybe a lot more people are investing more in the stock market, right? Mm-hmm. So the stock market rises, and that means if the stock market rises, well, what does that mean? The people who own those stock of the companies, they become what?
Wealthy.
They become wealthier. They become wealthier. But people who don't own those stocks, they don't become wealthier. So at the same time, low-wage workers don't have the same benefits, right? So it's like, so I have this fascinating statistic that I want to share with you. According to the Federal Reserve data from 2021, the wealthiest 10% of Americans own 89% of all stocks and mutual funds. I'll say it again. The wealthiest 10% of Americans own almost 90% of all the stocks in the stock market. And al contrario, the opposite, the bottom 50% of Americans own less than 1% of stocks, right? So clearly, when the Federal Reserve brings down interest rates,
there's an imbalance.
There's a huge imbalance. Yeah. Now, again, I'm just playing devil's advocate. You or me, we could say, okay, but then the 50% of Americans, you should be investing more into the stock market. You should play the long-term game. Your mindset, as you mentioned, should be better. You should learn this stuff and invest more, and don't continue to be part of the 50%.
Yeah,
I'm just throwing that out there, right? So
easier said than done, but yes,
100% easier said than done. I just wanted to mention that example. Now, I do have an example of how wealthy Americans benefited from more low interest rates in 2008, but I can skip that and just go into the Republican side. So the Republican says this. So the Republicans, the conservative, right? So an argument that they use to say that the Federal Reserve is a good thing is they say it gives America economic independence, right? So they say the Federal Reserve, right, emphasize the importance of the Federal Reserve independence. Because yes, technically, the Federal Reserve is independent from the political parties.
Okay.
Right? So the Federal Reserve independence to avoid political interference in monetary policy. So they say that the Federal Reserve is away from the government control. So because the Federal Reserve is not inside of the government,
which is true,
mm-hmm. right? They're not. It gives the Federal Reserve the opportunity to think more clearly and to make more objective, data-driven decisions that help the long-term stability of the economy. Now, I have read articles and other thinkers and other economists who say that the Federal Reserve is biased and the Federal Reserve is influenced by different political parties or the government. I haven't read that. But according to this argument, they're not together. They're separate. So obviously, if you're not part of the political parties, you can think better and make better decisions, even if it affects the political parties or not. Because the Federal Reserve's job is not about the political parties.
It's about what's better for America.
What's better for the American economy.
Yeah.
Right. And I'll mention, an example is during the Reagan administration, the Federal Reserve under Paul Volcker, which is the guy I mentioned, that mm-hmm. raised the interest rates to 20%.
Yeah, you did earlier.
This guy raised interest rates to combat inflation. And this caused short-term economic pain, but guess what? Guess what happened eventually? Long-term benefits, and we got out of that inflation. And again, I'm not thinking about Democrats or Republicans. I'm here to think about what's better for the American economy.
Yeah.
And do you want me to mention? There's also an argument against the Federal Reserve from the Republicans, or would you rather me go into the Libertarians? You tell me.
If you could, yeah, you could brief it.
Okay, so let me go. Let me go to the Libertarians.
Okay.
So it's funny. I couldn't really find any good arguments that Libertarians have saying that they're pro Federal Reserve, right? The only thing that they say,
I don't think they are.
No, they're usually not.
Yeah.
Right? And I like Libertarians. Maybe with this, I would disagree a little bit. The only thing they do say is that they'll say that when it comes to extraordinary circumstances, extraordinary, like a pandemic or a war, then yes, we do need the Federal Reserve to give us that cushion and to help us out. But one of their main arguments against the Federal Reserve is that it should be abolished or reduced a lot more, because they say that the Federal Reserve, because of their manipulation of bringing down the interest rates, it messes up natural economic cycles in the country. Because they're basically doing this. They're flickering up and down, basically, the interest rate. So they're saying it messes it up completely, and we get economic instability and problems. So that's really what they're saying. I'm not going to go into because they have a whole thing. I'm not going to go into all of it, but basically, and so that's what they believe. And actually, I did do a little bit of research, and then I want to hear what you have to say. Most countries have a Federal Reserve. Most.
Yes.
But there's certain countries that don't.
Like?
Panama. Panama is one of those countries. They don't have a central bank. They don't have a Federal Reserve. But they use the US dollar as the currency. Mm-hmm. So their currency is the US dollar, but they don't have a central bank. So what they're relying is, how strong is the American dollar?
Yeah.
That's why, for example, for America, it's very important to make sure that we're a strong economic country.
Oh, yeah, we cannot fail.
Because if we fail, first of all, our currency will go down to the garbage. And a lot of countries that use our currency, they're also going to go down, and they're going to go to China, or they're going to go to other stronger
euro.
Or the euro. They're going to go to other stronger currencies, and then we lose out. Right. So we're trying to avoid that. So it says here that banks in Panama, they're the ones that set interest rates independently, and the money supply is constrained by the amount of U.S. currency in circulation. So however much amount of dollars they have in their country, that's what they got to use. That is it.
Well, yeah, I mean, number one, they're depending on the U.S. dollar. That's one, right? Yes. So it's easier to do that than depend on your own, right? And at the end of the day, them not having central banks like we do, right? Or having a Federal Reserve, I believe it can impact them negatively. Mm-hmm. Because if one day they were ever to go into a war, okay, and not even a war, but if they want to a pandemic, or they want to stimulate their economy more, they wouldn't be able to.
Well, they'll do it in other ways, though.
Other ways, but it would be
tourism.
For Panama.
I mean, they do have the Panama Canal. That's like a huge historical thing, and
but that's
a lot of Americans go there.
Yeah, but that's mainly to transport goods, and stuff.
But there's things. Okay, I see.
I just don't think they would be able to overstimulate their economy and progress as fast. And if they were ever in a situation of war, it wouldn't go so well for them.
No, they would need their allies.
They would need the allies to come and help. They would need the big bosses to come and get the big bosses to come and give them money, so that they're able to supply for all these things. So at the end of the day, regardless of its pros and cons, I believe there's more pros for the federal government. For the Federal Reserve.
That's a different conversation.
I believe there's more pros that come out of the Federal Reserve that not only help other countries, but help our own as well.